I'm going to hand over to Simon, who's moderating. The institutions are here. This is going to be an absolute cracker panel. Super excited for this. Looks like Greg's found a seat. It could be at a bus stop. He could be somewhere. I've no idea. We'll see how he goes. Simon, over to you, man.
Hey guys, welcome back to another session we have going here. This one we are talking about is the institutions are here and how are institutions investing in crypto. So if you've been around the space for a few years, you've probably heard the saying, the institutions are coming, the institutions are coming. But what does it actually mean? And who are these institutions? Like these things, I don't even have the full answer for. But I am Simon Amery. I am a research analyst here at Collective Shift. And today I have a great panel of people here to help me understand who these institutions are and what that's actually going to mean for us investors in crypto. So today I'm going to introduce this lovely panel I've got here. I have Samira Tollo. She's the Chief Technology Officer and co-founder at Elbaite, one of Australia's leading cryptocurrency exchanges since 2017. She's a previous blockchain consultant with IBM, so that's a nice big name pool there. She's been pioneering multiple exchange innovations, including their unique self-custody marketplace. And most recently, the Elbaite vaults, which are fully segregated wallets for each customer, optimal for self-made super funds and high net worth individuals. Wow, kind of a lovely person to have a good understanding of what these high net worth people are going to be doing. Also joining us is Pratik. He is the head of research at Apollo Crypto. Now, Pratik brings over 13 years of experience in capital markets, having worked across multiple asset classes throughout the APAC region. So I'm super excited to talk to Pratik about this. He's an early adopter of digital assets. He's been actively investing in trading in the space since 2016. So you've beaten me by a year there, Pratik. I've been in the space since about 2017, but certainly not that active that early on. That's when everyone gets into the market at the bull market in 2017 and loses their mind. So that was me coming into the market. Pratik's got a little bit more years than me. And he's presided over the best performing digital asset funds in Australia and played a pivotal role in launching one of Australia's first spot Bitcoin ETFs. So obviously that's a huge inroad for the institutions. And finally, we are joined by also Greg Oakford. He is the general manager for Upside, a leading Australian and crypto Web3 community and co-working hub. He's an avid NFT collector and the co-founder of NFT Fest Australia. And of course, Greg is also Cointelegraph's lead NFT columnist. So he is a content writer like myself. So welcome, everyone. Thank you for joining us today.
Very excited for this.
Good to be here.
Awesome. Well, let's kick things off. And as we said, we're talking about the institutions. The institutions are coming, and we have talked about that for years and years. Now we're saying they're here. So I want to start this off with actually setting up this conversation with perhaps who are these institutions? Like, what are these institutions that everyone's talking about? Why are they interested in crypto? And what's taken them so long to get here? So I'm going to throw this one to you, Pratik. I think you're best to answer this one. So who are they?
Yeah, thanks, Simon. So before I answer who they are, I'd answer what took them so long. So crypto in the early days was a minefield. If you guys remember, there was Mt. Gox, there was Silk Road, there was a lot of stuff. There were, hacks, exchanges, Bitcoins being lost, back in the day, early days, a lot of issues with actually just accessing Bitcoin. You'd have to wire money into an obscure bank account somewhere in some Eastern European country. You wouldn't even know if you're going to get your Bitcoin. It was incredibly difficult to get access to Bitcoin in the early days. Obviously, institutions cannot touch an asset class like that because they are mandated by insurance policies. They have a fiduciary duty to keep your wallets and money safe. Of course, you cannot have mom and pop investors give you $100K and lose it all to some random coin on the internet. So in the early days, it was incredibly difficult to actually get access to Bitcoin. And so institutions wouldn't touch it. Even up until 4 years ago, it was extremely difficult to get access to Bitcoin in a safe, regulated way. We had Coinbase, but you couldn't do size there. Insurance contracts weren't there. A lot of institutions couldn't touch it still because it was still very difficult to sort of custody it with insurance. So it just prevented a lot of institutions from even entering this space. Today, we are in a very, very different place. Institutions can now freely dabble into crypto. There are places such as BlackRock has their Aladdin portfolio management system. You can buy it. It's insurance. It hooks into your tax compliance. Extremely and incredibly simple for institutions to now tap into this market and hedge their positions out as well using options. So today, institutions, it took them so long because the infrastructure wasn't there, the security wasn't there, and today it's all there. And so now we see a range of institutions from it started off with small family offices taking small bets, and now we are actually at the state and sovereign levels. So there are many, many states university endowment funds, family offices, superannuation funds, self-managed at the moment, hopefully in the future, more superannuation funds, and even sovereigns like El Salvador and, buying into Bitcoin. And the biggest one these days is corporates. So, MicroStrategy, Tesla, some of these guys already have Bitcoin on their balance sheet. So we're seeing all types of institutions get into this space because it's much more easier to do it now. Yeah, that's it.
So let's lean into that question there about MicroStrategy. You mentioned that. Obviously, most people in the space know about MicroStrategy. They've been a huge lead component in, making institutions aware of Bitcoin. But what is MicroStrategy doing, and why are they being so aggressive about it, and how are they leading the other institutions into the space?
Yeah, so a little bit of history in MicroStrategy. MicroStrategy IPO'd just before the dot-com boom in the late 90s. They did really well when they IPO. They're an enterprise software company, for people that don't know. In 2002, dot-com crashed. Their stock price basically nuked 90%. And they've been going sideways, stagnating for 20 plus years. So Michael Saylor, who discovered Bitcoin a couple of years ago, was actually faced with a problem where, I've got $400 million in my treasury, and your usual fixed income instruments and your treasury instruments are actually losing money. So everybody knows inflation is actually higher than reported. If you're getting 4% in your bank, real inflation is probably like 10 or 12% on the roads. So you're actually losing money. So he was poised with a challenge on how do I actually protect my company from this massive devaluation of currency and also just losing money every day, just keeping money in cash and fixed income. And he discovered Bitcoin. So he embarked on the Bitcoin journey, and he decided to put all of his treasury into Bitcoin. And now MicroStrategy is pivoted to a Bitcoin treasury company. And people would say he's actually almost become complete 100% into Bitcoin. He is now doing crazy things such as, crazy, but really good. I mean, makes a lot of sense, as in issuing debt at 0% interest and scooping up billions and billions and billions of dollars of Bitcoin, because he now sees the light and he actually understands the benefits of crypto assets in portfolios.
Very interesting, very interesting. And I guess we all know the value proposition of Bitcoin. And most of us kind of really understand, the value proposition of layer ones and why they have value for the future. But I guess my thoughts here about what about NFTs? What about meme coins? This is the space where retail are really involved here. And I'm interested to know, is there any institutional interest in, what is probably retail's biggest focus in crypto? And Greg, I'm going to throw this one your way. What's your thoughts on that?
Thanks, Simon. And I'll just apologize to everyone if you do hear some background noise. I'm stuck at the airport, so apologies if there is some background noise, but we'll do our best. I think in answer to your question, Simon, back to sort of what Pratik was saying, early on, everything is sort of fudded. Everyone has a lot of skepticism and cynicism against everything. And I saw that with NFTs in 2021. I don't come from a financial background. I come from sort of a marketing background, always got my finger on cultural aspects and especially internet culture. So Monkey JPEGs and NBA Top Shot made a lot of sense to my brain. Whereas a lot of the schools of maybe yourself, Simon, back in 2017, a lot of people who have been in crypto for some time really weren't believers of NFTs. We did have a bubble that burst, but I think similar to the bubbles that burst with DeFi and ICOs and all that kind of stuff, I see the same trajectory with NFTs. And you've only got to look in the last sort of 2 weeks. Many of the collections, like CryptoPunks, have doubled in value over the last sort of 6 weeks, let's call it. Many of the 2021, 22 collections are seeing price increases of 100 to 300% just in the last basically 7 days. So, why I'm sort of bullish on NFTs in general is I just think as a category, right? We talk about digital assets and we talk about Bitcoin and, its prevailing characteristic is there's only 21 million of them. And then people tell me you can't touch and feel NFTs, so they're not real. You can't touch and feel a Bitcoin as well, right? It's just it's another token, but it's non-fungible. And I think when you look at some of sort of digital art, previously to NFTs, there was no way for an artist that makes digital art to monetize their work unless they were to commission something. And that's not really their work because they're really doing work on behalf of someone else, or they can get cheap likes on Instagram. They can't monetize it. So I think digital or NFTs unlock a whole new category. So, I'll give you a couple of names and artists maybe for the audience to have a look at later in this session. But very bullish. And back to your original question, Simon, around institutions, we are actually seeing Bitwise. So, Pratik, correct me if I'm wrong, but they're one of the leaders in the Bitcoin and Ethereum ETFs. So they actually have carved out in their portfolio an NFT portfolio made up of digital art and some of the iconic collections like CryptoPunks and Bored Apes, etc. And I'll give you 3 DAOs that everyone I think should look into that are NFT collector DAOs, some of the bigger ones. Flamingo DAO, everyone should jot that down or find them on Twitter. Curated. And lastly, Doom DAO. Now, Doom DAO is a DAO that's specifically focused on collecting Xcopy. So I'm sure many people in the audience may have heard of the artist Xcopy, but he's right up there with Beeple as probably 2 of the more iconic artists at this early stage of the NFT arc. So I'll pause there, Simon. Thank you.
No worries. Thank you, Greg, and thanks for being a trooper and finding a quiet space at the airport there, mate. So you talked about NFTs. You didn't talk about meme coins, though. So we're a retail focus, and meme coins is where I want to know where people are buying my bags. But apparently, institutions aren't interested in that, which I'm not surprised about. But I guess that brings me to my next kind of question: is that institutions, they operate on a completely different scale to us retail. When we're putting $100,000, $10,000 into it, they've got multiple more zeros in their purchase amounts. And so what I kind of want to know is, how do they execute such large transactions without significantly moving the market? How do these institutions work in this space compared to how we do it? And I guess they've got limitations around their risk profiles and all that kind of stuff. But I thought, who else to better answer this than someone who runs an exchange? So Samira, what are these institutions doing? How do they do it? And are they going to buy my meme coin?
I love the setup around this question because it's really full circle and then going back to the retail. So yes, it is important to actually understand the difference between the retail market and the institutional market. They are just complete, I wouldn't say complete polar opposites, but there are absolute distinctions between the two that are important to consider, and then can also make us understand their trading behavior in general. So look, institutionals, as Pratik had discussed, they are these large funds. So even thinking about country reserves themselves. So I mean, what size are we talking about? It can start even at just the 100 mil, but it will definitely go up into the billions. And so these large transactions executed at one time, you can imagine what kind of price fluctuations and influence it can have if they were executed on a regular order book exchange. And so, I mean, they understand this, right? The institutions understand that their deep liquidity can influence smaller markets in such a significant way. And so, of course, they've got strategies that they have implemented, and these strategies are not new, right? So they are mirroring the strategies that they deploy in traditional markets. So some of the strategies that they use are OTC, so off the exchange, so over the counter. And so what this is you are not executing these trades on those order book exchanges. You've got partner liquidity providers that you're working with that may have large reserves of these currencies that you will execute the transactions over a period of time rather than on the spot on that day. And so what I wanted to discuss when talking about this is actually some of the past institutional buys and sells that we have seen, and maybe what we can learn about their participation in the crypto market. So let's discuss the recent one in Germany. We all know what happened there. So if for all those that aren't aware, Germany was successful in seizing a large portion of Bitcoin. So the exact number was around, I believe it was around 200,000 Bitcoin. And so the German government in the end decided that they wanted to just sell this off. Their priorities when selling this off was not actually about maximizing the return on this Bitcoin. What they instead prioritized is actually the risk reduction of holding this crypto asset. So in their eyes, in their investment strategy, they were considering the risks associated with holding crypto long term. Now, there was a lot of scrutiny around how they did execute this and if they should have even executed this. And so we've got some of the MPs arguing that, maybe we should have kept a large portion of that as reserve. And of course, we're seeing, 6 months later, they definitely would have benefited on a reserve. And so, look, in the end, institutional participation in a sector like cryptocurrency will create a lot of volatility. So if we just consider the market cap of the entire crypto market, so we're currently sitting at this bull run, we're at 3.8 trillion, the entire cryptocurrency market itself. Now, comparing it to traditional markets like Nvidia at 3.5 trillion, we're at par now with a single company. The entire crypto industry is at par at the valuation of a single company in the traditional markets. So we have yet to grow our liquidity to increase the participation of institutions, but it is absolutely getting there. And so that's what makes meme coin participation at that institution level really difficult, because meme coins traditionally, their liquidity is still not there. So if we just consider the most popular meme coins, Doge is the most popular. They're sitting at $63 billion entire market cap. Now, if a sovereign reserve is looking at $100 million buy, that's taking all of the Dogecoin in supply plus more. It's just not going to happen. So the meme coin industry needs a lot of price growth before we see institutional level participation, I would say.
I'm sure everyone's disappointed to hear that the institutions aren't going to come save us from our meme coin allocations. So that brings me to my next question, which I think I would like to have an opinion from all of you here. And that is, if these institutions are here, if these institutions, by the sound of it, predominantly buying Bitcoin, then what's the best way for a retail investor like all our audience to take advantage of this or even front run these institutions? How do we as the individuals benefit from these institutions coming into the space? And I might throw this to Greg first.
Okay. Thanks, Simon. First and foremost, obviously I have a strong bag bias and curious and interest bias towards NFTs. But again, what I said earlier, I just don't think many institutions at all are thinking about NFTs yet, just like they weren't thinking about Bitcoin maybe 5 or 6 years ago, and just like they weren't thinking about Ethereum and other altcoins more recently. Some of the smart ones are, but ultimately NFTs can often be a leverage bet on ETH as well. And now we've also seen the rise of NFTs called ordinals on Bitcoin over the last sort of 12 to 18 months as well. There are NFTs on many other chains, including Solana as well. Apologies for the background noise, just getting rugged here a little bit. Yeah. So the Virgin Australia lady definitely wants to buy autoglyphs too, which was my next point. But yeah, some of the collections I would encourage everyone just to go down the rabbit hole with. If you're not familiar with Lava Labs, they're the creators of CryptoPunks, autoglyphs, and Meebits. But in particular, autoglyphs, I think they're sitting around about 130 ETH floor right now. They started off as, I think, about a 0.1 ETH mint or around about that range. But there's many iconic art collections that I think institutions will be coming from. And if I reference one of the crypto Twitter biggest influencers, Punk6529, who actually has a collection of his own called The Memes, there is an actual meme called The Institutions. Don't let the institutions steal your JPEGs. Now, everyone obviously pokes fun at NFTs by calling them JPEGs and will right click and save. But ultimately, he has planted this meme a couple of years ago with a lot of collectors. And I really think it is going to ring true, just like it rings true now as we're seeing institutions invest in traditional crypto. I might pause there, Simon, because we're about to get interrupted again.
No worries. Thank you very much, Greg. So Greg's kind of alpha there is, there are some NFT projects that have the potential to front run some institutions. But I think that's going out on the risk curve for a lot of people, or maybe even out on the not understanding. So it's probably a space where you need to spend a bit of time learning. But I might throw it to Pratik now to ask, what do you think? Yeah.
Simon, could I just jump back in? Matt Williamson's just messaged me and just wanted me to repeat the 3 collected DAOs that I mentioned earlier. I might have said those a little bit too fast for the audience. So it was Flamingo DAO. So just have a look on Twitter or Google Flamingo DAO. Maybe Googling is not the best bet. Go to X. Curated. And then finally, the last one, which was the X-Copy Focus DAO, is called Doom DAO. Not Doomer DAO, but Doom DAO. Thank you.
Awesome. Thanks, Greg. Thanks, Matt, for messaging that through as well. Pratik, let's take your take. How's retail take advantage of these institutions coming into the space?
Yeah. So first and foremost, I think a lot of people actually think they're too late to the party. The reality is not. I speak with plenty of large institutions, and I have friends at big investment banks and so on, and they're still just looking at this but not actively deploying. So right now, in my opinion, they're still behind the curve as well. So you're not late. That's number one. So you can front run simply by, depending on your risk curve, buying Bitcoin. Multiple ways of buying it. You could use Samira's exchange, you could use ETFs, what have you. Now, typically, if you want a more risk-weighted return, typically when institutions enter, they go for the blue chip assets, just like traditional equity markets. Then they look at the mid caps, and then they look at the small caps. Now, I'm aware of some of the New York-based hedge funds that are like, all right, we've already got Bitcoin, but what's outside of that? They typically land on Ethereum and shortly after on Solana. And then there are a bunch of other coins over there as well. Now, Ethereum today has an ETF. Solana doesn't. We may get an ETF for Solana. And there are a bunch of other coins as well that may have ETFs under a Trump administration. So if you typically want to front run them, not financial advice, but you just look further down the risk spectrum. So if you're very conservative, you just want something like a safe bet, Bitcoin's your bet. But institutions are typically then looking at what's after the big blue chip, where they can get more returns. And typically how institutions allocate is, they'd allocate 1% of their portfolio to Bitcoin, and then they'd allocate 0.25% of their portfolio to, say, Ethereum or Solana or one of those other coins. Now, 0.25% seems nothing, but 0.25% for $1 billion fund is still like $250 million. So, or to $25 million, and then there are 10 billion and 100 billion funds there. So $200-300 million orders can come in on some of these other coins as well. And once it gets into the institutional machine, then you have the salesman. I mean, technically, just like Larry Fink, who's the CEO of BlackRock, he's going out and practically talking on CNBC, Fox, Bloomberg, all of those news that, I believe in Bitcoin now, and, I get it. So you get the huge institutional sales machine behind it. So if you want to front run them, my recommendation is to look further down the risk spectrum, look at coins that resonate with you, look at coins with product market fit, and potentially take some bets over there, as the institutions will soon further start looking down the risk spectrum.
Thanks, Pratik. So once again, institutions aren't buying my meme coins, and that's okay, because just like these institutions, Pratik said, I've got a very balanced portfolio, and predominantly most of my portfolio is in Sol. I only have a very small percentage of meme coins, which is probably what all of you should be doing as well. Finally, Samira, what are your thoughts? How do we take advantage of these institutions coming?
Yeah, actually, I wanted to add to Pratik's points about the ETF participation. I think it is a good point to understand why are institutionals following an ETF purchase flow rather than a direct purchase, right? And that actually comes down to regulation, unfortunately. So with all of these institutions, they are mandated by actually a long list of security aspects that they need to consider, and regulations as well. And so when they are directly exposing themselves to the market and getting crypto directly from an exchange, they are a little bit more exposed. Crypto exchanges at the moment are not regulated operations, whereas ETFs, especially in Australia, we've seen actually really good regulation come out of it. So 2 years ago, we saw that the ETF regulation scope did add on some crypto regulation on there. And so that is why in Australia we did see a lot of institutional participation go through ETFs rather than direct to the market, because ETFs add a layer of regulation and licensing that the institution can benefit as a consumer of that product that they bought. And so that is important. And so, adding to Pratik, right, follow where the ETFs are happening, and that is where institutional participation should occur first, and you can benefit from that as a retail investor, right?
Awesome. Thanks, Samira. And we're getting close to some Q&A, but I got one more question, which I kind of do want to answer, because I think it's an important one in my mind anyway. And this is the question around, crypto was supposed to be about breaking from the existing financial infrastructure, breaking from TradFi and being this whole new industry. But we're talking about TradFi coming into the space where, crypto has survived a long time without them here. And so my question is, do we need these institutions in this space? What is the long-term good? And maybe someone put in there, what's the long-term bad of having them in the space in crypto in general? And Pratik, I might throw it to you if I could, please.
Yep. So do we need institutions in the space? Yes. The reason why is you could have like a subculture. In culture, you can have a subculture, a niche. You can have 100,000, 500,000, a million, 10 million people looking at it. But if you want to grow an asset class to mass market, you need the blessing of the state, the governments, and the broader TradFi community. As much as the crypto bros and we like to go hate on them, the reality is there is a wealth of finance started like in the early 1400s, in parts of Europe and like has expanded to it. So there's a lot of wealth of knowledge and ways to manage risk and stuff that comes with that over 600-700 years of history. So that comes into crypto. So we will benefit from that. I mean, in all honesty, even 5-6 years ago, if you use many of the exchanges, there's a high chance of you getting rugged or hacked and all of that. The institutions coming in has forced crypto exchanges to also level up. And now you can have reasonable confidence that you're going to be fine, using any of the great traditional crypto exchanges in Australia globally, because we are forced to level up as well to cater to those demands. So institutions are here, and we definitely want them here, and we want them to play with us so we can take this asset class to the next level. Does it benefit crypto? Yes. Is there any downside of institutions coming in? Right now, it's all bullish. It's thumbs up. In 10 years, when the institutions are in, they'll start doing all types of products such as options, swaps, credit default swaps, all types of things. And so maybe retail wouldn't have the edge anymore that they have today. So I think the next 5 to 10 years, retail, you can make an outsized return if you're active in the market. In 10 years, when institutions have completely cornered it, then you're going to have your usual CFA experts that are going to completely arbitrage any edge that you may have today. But in my opinion, that's about a decade away.
Yeah, so that kind of makes sense to me in the fact, we can't keep having these ridiculously crazy gains forever because eventually everybody sees that and wants a piece of it, and that reduces the volatility. And I do agree with you that we do need institutions in the space because, I'm predominantly here for an investor. You can be, an evangelical crypto person who wants to, bring down the rest of the financial system. You can be really nerdy and geeky on the blockchain technology and how cool it is, or you can be an investor. And, I'm kind of a bit of all three, but very much so an investor. So I want to make money from this space. So institutions at the moment are coming here to make us some money. So I think that's a really positive in the space. And it, as you said, it legitimizes it for a lot of us. Okay, so let's get to some of these questions now. I'm going to have a look over here and read some. So Jim here has got, Jim's got, does this cycle have the potential to be the most volatile yet, given the large institutions involved? Samira, what's your thoughts on that one?
I mean, we already did see with Bitcoin, right? At the start of the year, Bitcoin hit its first all-time high of this year, and actually of the 4 years since the last halving. And that at the start of the year, there was a lot of actions happening. But one of the things that happened with Bitcoin was the ETF, was the Bitcoin ETF. And so that did create a huge fluctuation well before the halving and well before the post-halving hype that we also see as well. So, I mean, look, past behavior does not predict future behavior, but I think the deep liquidity that the institutions are bringing and the fact that actually the entire crypto market is still relatively small, I think we can relatively highly predict actually huge volatility at this moment, yes.
Yeah, well, it's still an emerging space, so volatility is part of the journey, but it's also why we have such huge gains that we can get from the space. So another question here from Anonymous is, are we worried about MicroStrategy's aggressive Bitcoin strategy and leverage? Are they going to have a negative impact on the market? Pratik, what are your thoughts on that?
No. So one of the important things to understand now is MicroStrategy's Bitcoin is not collateralized. All the big loans that they're drawing are 0% at a 0% interest, where the purchasers get a call option on MicroStrategy stock. So whatever MicroStrategy is doing, its stock can go up and down, it can do a lot of volatile things, but the look through to Bitcoin is very clear. I think over the next 3 years until the first convert node expires, we're fine. I mean, that's completely fine. There's no risk to Bitcoin imploding because something happens to MicroStrategy. in 3 years, the first convert note comes due. It's about $1 billion. Hopefully, Bitcoin's much higher. Even in the event Bitcoin's a bit lower than when it is today, which is a very low probability, MicroStrategy is just going to be able to roll it and refinance it. It's like very typical in traditional finance. Hopefully, interest rates are lower then, and so they can just roll it and continue running this for a long time. Actually, the only risk is if Bitcoin's price substantially drops to, I would say, $15,000 or $20,000, then MicroStrategy might run out of lenders, and they would be forced to liquidate some of their Bitcoin holdings. But the way I look at it, with a pro precedent in the US, they've got the House, they've got the Senate, they've got the White House, they've got Congress. They're talking about the strategic Bitcoin reserve. I mean, if you're just looking at it in probability terms, it's extremely low that Bitcoin is going to be lower than where it is today. And of course, when Bitcoin leads, the rest of the market goes with it over time. So I think there's very negligible risk with MicroStrategy for the next 3 to 4 years, and then we'll assess again in 3 to 4 years. By then, we'll also have another halving. So it's going to be even more. Bitcoin's even going to get scarcer.
Yeah, awesome. And Pratik, I really love your answering very bluntly right at the start, no, and then let me tell you why. That's really good. Okay, so I think that is all we have. So thank you very much, Samira, Greg, and Pratik for joining us today.
Let's go.
Ben, back to you, mate.
Guys, that was amazing. Well done. Can you hear me now?
Yes, I can hear you this time.
Sorry, Greg. I was ripping shreds off you, man. I saw backpacks, I saw people, I saw gates, I saw airplanes. What happened, man?
Yeah, a little bit flight delayed, a la your Miami trip to VCon in 2022, Ben. So maybe you can tell your audience about that later.
Yeah, lost the passport, missed the flight. But anyway, guys, thank you so much. That was amazing. Can I just maybe quickly go around the room and just give a 30-second how people can find your stuff, how can people follow you, your websites, social handles. We'll start with you, Samira.
Awesome. So we are Elbaite. We have been operating in Australia since 2017. So we're one of the earlier exchanges available for Australian investors. We've been focused on custody, what custody means as an investor. And so one of our latest products that we've launched is the Elbaite Vault, which are perfect, as we described, for SMSFs. They are fully segregated wallets that is attached to exchange functionality as well. So yes, find us on www.elbaite.com. Thank you.
Yeah, I'll go next. You can find us. We run wholesale institutional funds, 7 years of track record. Some of the best performing funds globally, different strategies. So if you're a wholesale investor, you could follow us. You could go to www.apollocrypto.com. Personally, I am on x.com with just my name, Pratik Kala, and even LinkedIn. I post a couple of market takes over there, which you may or may not find beneficial, but I definitely cover all things crypto and MicroStrategy and all of those things as well.
Yeah, you can find me at Greg Oakford on X, and I'm sure you can find me on LinkedIn as well. The other thing I'd encourage you to do is just, if you're interested in any of the artists or any of the collections that I spoke about today, just Google my name along with Cointelegraph and my column. I'm a feature writer for Cointelegraph. So many of the artists and NFT collections that I mentioned today, you'll be able to find some more information on that. Or if you're struggling to find me on X, go to @babybackberg, who has literally posted about me 17,000 times in the last 2 weeks. So thank you, everyone.
There's your flight. Thanks, guys. And also Simon's a senior analyst at Collective Shift. So if you want to see him write all about meme coins, the market, everything, you can go over and check out Collective Shift. That's where he is. Team, thank you so much. That was amazing. Appreciate it. And we'll see you all very soon. Thanks, guys.